Let's dive right into an absolutely fascinating mystery for today's explainer. We're going to look at two vastly different investors operating in the exact same market during the exact same years. Now, one of them was undeniably brilliant, like off the charts smart. The other, well, by his own admission, he mostly just took naps. But the results they achieved, they're going to fundamentally change how you view your own money. Consider the sheer contrast here. One of these guys was a certified genius, a man who literally won a Nobel Prize for figuring out how financial markets work. Yet he somehow managed to blow up $4.6 billion in a matter of weeks and honestly nearly dragged the entire global financial system down with him. And the other guy? He bought boring companies, ignored the daily news, and essentially just took naps. Yet he became quietly, unfathomably wealthy. It proves a totally vital point. Success in investing really isn't about raw intelligence. I mean, the smartest guys in the room went broke.
The entire puzzle comes down to what we're going to call the genius tax. This is the devastating price you pay when you try to be smarter than the market, instead of simply being more patient than it. And the cruelest joke of all is that the smarter you feel while paying this tax, the more it actually costs you. Warren Buffett really says it best: the absolute most important quality for an investor is temperament, not intellect.
Act 1. The cost of action. Why doing more makes you less. To explain this, let me introduce you to our everyman, Henry. So Henry is 34, he's sharp, he reads the financial news every single day, and because of his sort of hyperactive anxiety, he's about to walk straight into 3 major action traps. First up, trying to time the market, waiting for the dip or scrambling to get out before a crash. Second, paying high fees. And third, overtrading driven by fear and greed. When Henry is constantly checking his brokerage app and firing off trades, it feels like he's taking charge. But in reality, that activity is literally just burning his hard-earned money.
And it all comes down to this massive, hidden reality: 50%. You see, the market doesn't just climb in a smooth, polite little line. It does most of its heavy lifting on a tiny handful of explosive days. If you just leave $10,000 alone for 20 years, it grows to roughly $65,000. But if you try to time the market and miss just the 10 best days out of those 2 entire decades, your total returns are cut in half. And guess what? Those 10 best days almost always happen right next to the most terrifying worst days.
Then we have the trap of fees. Imagine you've got a silent roommate. He pays no rent, he does no dishes, and you never even see him. But over 30 years, a seemingly tiny 2% active management fee quietly swallows nearly half of your lifetime wealth. Without fees, that $100,000 becomes $760,000. But with just a 2% fee, you're left with just $430,000. That silent roommate basically just walked out the front door with hundreds of thousands of dollars.
To see how this plays out in the real world, we just have to look at the legendary $1 million bet Warren Buffett made back in 2007. He wagered that a cheap, incredibly boring S&P 500 index fund would beat a hand-picked basket of 5 elite hedge funds over a decade. Now, these pros have the fastest computers and the smartest minds on Wall Street. But the result? The boring index fund was up nearly 126%, while those brilliant hedge funds, after taking out their hefty fees, managed just 36%. The hyperactive professionals lost to a robot that literally just sat there. Act 2. The danger of ego. When brilliance becomes a bomb.
Okay, so once we get past that urge to constantly act, everyday investors like Henry are confronted with ego traps. These include investing outside your actual knowledge, anchoring on past prices, blindly following the crowd, and, without a doubt, the most dangerous of all, using leverage. It is remarkably easy for smart people to fool themselves here. When a stock price goes up, it is just human nature to mistake that rising price for your own personal genius, even if you have absolutely no clue how the underlying business actually makes money.
The crucial point here is understanding your circle of competence. This means knowing exactly where the boundaries of your genuine business understanding lie, and stubbornly staying inside them. Warren Buffett famously missed out on the early days of Google and Amazon because tech was just outside his circle. And sure, it stung to watch other people get rich, but staying inside that circle is exactly what protected him from the devastating dot-com crash that wiped practically everyone else out.
And hey, what happens when you do make a mistake? Because you will. You have to swallow your pride. Buffett bluntly says, the most important thing to do if you find yourself in a hole is to stop digging. This is the classic falling knife trap. Just because you bought a stock at $50 and it drops to $30 doesn't automatically mean it's on sale. If the business is actually rotting underneath, buying more at $30 is just shoveling cash into a dying fire to protect your own ego.
All right, It is time to finally unmask those geniuses from the very beginning of The Explainer. They were Nobel laureates running a fund called Long-Term Capital Management. They were undoubtedly brilliant, but their ego led them to the ultimate trap: leverage. They borrowed money at a staggering 25-to-1 ratio to boost their returns. But leverage is like a magnifying glass. When the market experienced a perfectly normal 4% drop, their massive leverage meant they were instantly erased 100% via margin calls. Poof. $4.6 billion. Totally gone. Buffett's longtime partner, the late Charlie Munger, summarized this exact danger with his classic biting wit. He said, "There are only 3 ways a smart person can go broke: liquor, ladies, and leverage. Borrowing money to invest literally saws off the floor beneath your investments. A patient investor can easily sleep through a 25% drop, but the leveraged investor? They get forced out at the absolute bottom." Act 3. The reality of belief. How you see the market determines your survival.
So even if someone like Henry learns to control his ego and just sit still, he can still get caught in these final belief traps. People constantly confuse price with value. They sell their winning stocks way too early. They completely botch how diversification works. And, out of pure fear, they hide their wealth in cash. Let's break these down, because fundamentally misunderstanding value and compounding is absolutely fatal.
First up, we have to untangle price from value. Price is just a flashing number on a screen. It's totally dictated by the crowd's daily mood swings. Value, on the other hand, is a tangible slice of a real, cash-producing business. Price is what you pay, value is what you get. When you truly internalize this, a 30% drop in price isn't a reason to panic and sell. It's actually a massive sale on a highly valuable business.
And once you find that value, you've just got to step back and let the math do its work over time. $10,000 invested at 10% hits $174,000 at year 30. But if you leave it for just 10 more years, it explodes to $452,000. More than 60% of your total wealth is generated in that final decade. When you sell a winning company just because it went up 50% and you want to lock in a profit, you are violently amputating your own future wealth. But here's the catch. Getting to that explosive final decade means you have to endure long stretches where it feels like absolutely nothing is happening. You really have to realize that the boredom isn't a sign the plan is broken. The boredom literally is the plan. Those flat, seemingly unremarkable years are so crucial because that is when you are quietly accumulating the cheap shares that will eventually go completely vertical.
This also clears up a massive misconception about diversification. People hear Warren Buffett say diversification is protection against ignorance, and they get totally confused. But here is the actual truth. If you analyze businesses for a living as an active stock picker, yes, you should concentrate your bets on your absolute best ideas. But if you're the average person who just wants to live their life, maximum diversification through a low-cost index fund is the absolute smartest move you can make.
Do you want the ultimate proof of this whole philosophy? Just look at Buffett's own will. Upon his passing, the inheritance for his wife isn't going into some complex hedge fund or concentrated stock bets. He instructed it to be placed in an incredibly simple portfolio: 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. Diversify according to your ignorance, not your ego. Finally, we have to talk about the ultimate false sanctuary: cash. After hearing about terrible market crashes, you might think hiding in cash is safe. I promise you, it isn't. At a perfectly normal 3% inflation rate, cash silently loses 50% of its buying power over 20 years. Your money is just dying slowly in a comfortable chair. Short-term emergency money? Sure, that belongs in cash. But long-term wealth parked in cash is a guaranteed, volunteered loss.
Conclusion: temperament over intellect.
So the cure to this genius tax isn't a higher IQ or some fancy new algorithm. It's humility and patience. Let's look back at Henry, our everyman. Henry finally beats the market, but he doesn't do it by getting smarter or finding a secret stock tip. He beats the market by simply stopping his self-destructive habits. He decides to hold his winners forever, he moves his money into a simple index fund, and most importantly, he finally puts the brokerage app down. He just stops paying the genius tax.
So I want to leave you with this really powerful question, inspired by Charlie Munger, to take away from this explainer today. Are you trying to be consistently brilliant or just consistently not stupid? Remember, the richest investor in history got there by taking naps and letting time do the heavy lifting. The choice of which game you play with your own money is entirely up to you. Thanks so much for joining me, and I'll catch you in the next explainer.